Good evening, everyone. I hope each and everyone is keeping good and in high energy of your preparations. And welcome to the second part of Cost of Capital. I am CPA Manabha Verma, and we continue our journey from where we left on Tuesday. We had a good knowledge enriching session and full of energy. I'm sure we will be expecting the same momentum today. But before I even start onto that, just wanted to look at a couple of questions which were there in our query panel already. So Naveen had asked about under YTM method, if NPV at 10% is negative, then to find out the positive NPV, which rate should we select? Lower than 10% or more than 10%? Guys, anyone would like to answer that? If the first rate is giving you a negative NPV, should the second rate will be lower or higher? We discussed that, right, on Tuesday. Any thoughts? Let me see who wants to go ahead with the first. It has to be lower, right? It has to be lower. It is lower than 10%. So that means it will be lower than 10%, right? Because if you're talking about dividing by a lower number, you will get a higher result, and that's what you want, right? The other NPV should be positive. It will be low. It can't be higher. Okay. Then second question was realized yield from Shivangi. Shivangi, we discussed a realized yield approach in the last class. I would request you to probably go back to that discussion again. We look at this example where we discussed about what has been realized in the past and how we have calculated the geometric mean of the same, and we expect that to continue in the future. And we talked about of the assumptions. That's why we critically appraise that it is not very commonly tested, but we should be knowing that, right? That whatever the result, we are talking about dividend, we are talking about the capital appreciation. So those are the things we need to know, that those two things, because if you see every year we discuss this illustration that the dividend plus the increase in the capital appreciation, we calculate the return for every year and then we calculated the geometric mean, right? So that was what we discussed. Okay, then a couple of students had a query in the past year exams. I think Alok had mentioned that, and one more student. I request guys, any doubts you may have in the past year exams or any other query, I would request you to drop an email at fm-inter@ica.in so that we can have a look at that later on. Okay. Calculator short tricks. Okay. Abdul was asking about the question. Vinay was, why we're taking cash inflows negative and cash. Okay. Vinay, because we are talking about from an expectations from investor perspective. Whenever we discuss that and to calculate the IRR, initially we have an outflow and later on we have an inflow. I would answer two parts, Vinay. Make sense? One is from expectations from investor perspective, and second that we are looking at from a calculation of IRR, which generally involves initial outflow and subsequent inflows. Anyways, so coming to the calculator tricks, guys, I think Abdul asked me about the calculator trick. So guys, if you have a basic calculator in your hands, if you just simply want to calculate, let's say, although you will always have the present value annuity factors with you, don't worry about that in the question itself, but God forbid you need to calculate something, check yourself, or in one of the questions some factor is not there, you want to calculate it. So if you have a basic calculator which will be allowed, then you have to just let's say it's 10%, right? We'll just do 1 divided by 1.1, and once we press equal to, we will probably have 0.909. Now at that time we can all press M plus, and let's say we have to calculate the present value annuity factors for 5 years. We can press equal to, we will see next year's present value factor 0.826. We can again press M plus, then again press equal to, and so on. Do that 5 times till your present value is 0.621, and then when you do a grand total or MRC, then you will see 3.791. So You guys can try that later on, guys. I think calculator approach is like, it's anyways needed if in case you are probably not given the factors, which is very unlikely to happen. Okay. Okay, great. So, so guys, we need to continue then where we left. We had to just cover up one important aspect of cost of capital, that is cost of retained earnings. If you remember, we discussed in the capital asset pricing model, also in the terms of the Gordon dividend model, especially in the Gordon dividend model, where we discussed K is equal to D1 upon P0 plus G. And where I said that, okay, hey, G is the cost of the earnings retained. What kind of a growth you want to see in the earnings which are retained in the organization in terms of the opportunity cost. Had that earnings be distributed to you guys or to the investors as a dividend, then it's a different ball game. But every organization retains some earnings in the business, and they would want to see the growth in that business, right? So that is why we need to appreciate the fact that even the retained earnings have a cost in terms of the expectations, and that's what we discussed, right? So so then we're talking about whether we are looking at the cost of retained earning would be same as cost of equity, because retained earning is part of the cost, equity itself. Now let us talk about this. Of course, this is nothing but in terms of the opportunity cost, because we are looking at the dividends which are foregone by the shareholders. That's what we are looking at. Now, the only point is, if the company has to issue a new equity, please listen to me. If the company has to, okay, I just want to check the query link, guys. I think Sharan Krishnan, I believe your when you're posting a query, it's kind of coming as blank multiple times. So I believe that there is some technical glitch at your end. So make sure you just press submit it once. Okay. Okay, great. So coming back to this cost of retained earnings. Now, in the case of a new equity, mind you, you might have to incur any flotation cost. And that is why the cost of equity in that case would be higher than cost of retained earnings. We can other way around say that, okay, cost of retained earnings and cost of equity is same when there is not a new equity. So general rule is that. So what is my general rule, guys? My cost of retained earnings will be equal to cost of equity, except for where the new equity is to be issued. Because in the new equity, there will be flotation cost. And hence, Abhishek asked me, what is flotation cost? Abhishek, when you're issuing the securities, there could be, cost in terms of the registration or in terms of any kind of admin fee. So all that is part of the issuance cost, right? Our net proceeds will be less, right? Let's say you're issuing 100,000 or 1 lakh shares of 10 rupees. That is 10 lakhs, but there are some flotation costs of, let's say, 5,000 rupees. You're not getting 10 lakhs, but you're getting 9,95,000, right? That's flotation cost, right? So when there are flotation costs, now this is important. We are looking at cost of retained earnings from two perspectives. One, when there is no flotation cost, no taxation, and we are looking at from a perspective of the expectations, the cost of retained earnings is equal to cost of equity. However, when there are taxes and flotation cost, so there is a flotation cost, that means instead of 100%, you are getting 98%, 97%, guys. So whatever my cost of equity, I am multiplying that is by 1 minus F. So let's say if my flotation cost is 2%. So 1 minus F will be what? 98%, right? So whatever the cost of retained earnings, we multiply that by, or other cost of equity, we multiply that by 98%. As I said, the cost of equity then will be higher, right? Cost of retained earnings will be less. Also, we multiply this by 1 minus T. Can anyone tell me why? Sharon, I have seen your point about illustration 4. Sharon, I request you to probably will kind of, if we get a time, we can look at that at the end, or if in case we don't get that time to go back to that, please email the exact query. What do you have in that, right? Okay. Okay, so a question from Abdul is brokerage is part of the flotation cost. Yeah, so basically any issuance cost, right? Any issuance cost. So we're paying brokering, stock registration, so all that will be part of it. Anyways, so guys, can anyone tell me why we are multiplying this by 1 minus t also if there are taxes? So let's see who want to answer that. Of course, there is nothing called tax deductible here, but still I want to see what is 1 minus t. So Vinay says due to dividend tax. Vinay, you're absolutely close to the answer I'm looking for. In fact, pretty much it. You know, the best way to think it from an investor perspective, had that been distributed as a dividend, the investors would have paid some taxes, guys. Make sense? From it, because we are anyways looking from opportunity cost perspective. So if the question gives you the taxes and flotation cost both, then make sure you remember the formula for cost of retained earnings, that is cost of equity into 1 minus t into 1 minus f. We need to know the logic. Why we are doing 1 minus c? Because the investors would have paid tax had that been distributed. Why 1 minus f? Because the net proceeds would have been less if the flotation costs are there. Great. Divinesh, Varsha, Sabyasachi, Ankit, absolutely. So I think I'm sure Prachi also said the same. So good answers, guys. I think I'm seeing like good responses already. Wonderful. So let's see an illustration here. So face value of equity shares of a company is rupees 10, while current market price is 200. Now, company is going to start a new project, is planning to finance partially by new issue and partially by retained earnings. We have to calculate cost of equity shares as well as cost of retained earnings. If the issue price is 190 and flotation cost will be 5, dividend is expected to be 10 and growth rate will be 5%. Now, my point is, we discussed 5 models. For calculating cost of equity. What we need to calculate here is cost of equity and cost of retained earnings. Which model do you think we should apply here? Gordon dividend model, Gordon growth model? Yeah, Jaykumar, absolutely correct. Because see, we need to also identify which method needs to be applied, which is based on the given information. Yeah. So now my point is, Pranav says dividend is paid after. Okay. Pranav, we were talking about from a perspective of had that dividend be distributed to the investor, what investor would have done? There would have been tax on that, right? So investors' expectation would have been net of tax. Anyway, so Basudev have a question. Is the syllabus same as change? No, again, Basudev, whatever is in your latest curriculum, that's what you are following. There are no as such turnaround changes. Okay, so coming back to this, guys, can anyone give me the answer for cost of equity here? The Gordon's dividend? Using the Gordon's model, what would be the cost of equity? Now, this is a very, very interesting question, to be very honest. Why I'm saying this is because you have to calculate probably the cost of equity 2 times. Let me explain you why. One is you are talking about partial financing by cost of retained earnings and partial by the new equity shares. So, if we are talking about cost of retained earnings, Do you agree that that would be cost of existing equity? In that case, it would be your, D1 upon P0 upon plus G anyways, which is like the market price. So what exactly we need to do, guys? So D1 is 10, market price is 200, and my growth rate is 0.05. So that comes out to be 10% here. That comes out to be 10%. Everyone with me on this? For cost of retained earnings, we will be talking about existing equity. However, when we are looking at the new issue, in case of new issue, we will have to say net proceeds. In case of net proceeds, my denominator is not 200, guys. Denominator becomes 190 minus 5. Everyone with me on this? For the new equity, it will be 10 upon 185, guys. I hope everyone with me on this. So cost of retained earnings, it was very simple, 10%. But for the new equity here, we are looking at 10 upon 185 plus 0.05. That gives us 10.41%. I think some of you calculated 10.38 or something. I believe that is now corrected. I think some of you got confused between market price and the net proceeds. So market price for the existing equity, net proceeds for the new equity. Okay, so mind you, the one small thing in that question was that it was already telling us that next year's expected dividend was 10. So don't multiply that by 1 plus G. Okay, so one more illustration quickly when we talk about presentation of, or rather existence of, my flotation cost and the personal income tax. Any thoughts? Okay, there was a question regarding the PDF, guys. I believe you guys would have downloaded this particular presentation already. It was, I think, uploaded by me before Tuesday's lecture. So all of this is in there already, guys. Okay, someone was asking me about the new equity. Sankaran, in the new equity, you are clear now. Great, thanks. So in the new equity, we are looking at net proceeds. Thanks for confirming. Okay. Second question, guys. The illustration at the center here. Cost of equity of the company is 20%. Flotation cost is 5% and personal tax is 30%. So you don't need to do anything. You just multiply the 20% net of tax and net of flotation cost, and you will get the cost of retained earnings as 13.3. It's as simple as that. Okay, Honey has a question. Okay, Honey, let me just look where is your question, because there are too many queries. Honey says if new issue is there and no flotation, so Honey, flotation is zero now. Why would a formula will change, right? Ideally, it will not be there, but hypothetically, if I agree to your point, flotation cost will be zero. So it will be more or less your, whatever the issue price is. Make sense, everyone? Okay. So there's a couple of brain teasers for everyone here. We need to calculate the cost of retained earnings in two different scenarios. So we have A and we have B. Basically, if I'm asking you to calculate this, what exactly I'm asking, guys? Cost of retained earnings. We're talking about cost of equity, right? We're talking about cost of equity. And if that is the case, both the questions, question A and B, are giving us the situation with respect to a growth model and capital asset pricing model. So what would be the answer for A, guys? Quickly. Cost of retained earnings or cost of equity for point number A at the bottom. already getting some answers. Mind you, we are talking about a D0 here, whereas we would be needing D1. Ashish, yeah, please, these lectures will have to be in the standard language for so that everyone can understand. So we can check that separately. Okay, so okay, so I'm getting answers 0.5, which I do 1.05, 50 plus 0.05. And for B, guys, so 15.5 looks to be a good answer here. Whereas in the capital asset pricing model, I think I already got some answers as 11.2, which also is absolutely correct, because we're talking about RF plus beta into RA minus RF, which is 11.2. Great. So let's do one thing. That we give ourselves another opportunity to look at a couple of more MCQs. We did 2 MCQs on Tuesday. I want you guys to answer these 2 MCQs now. So you have a couple of MCQs, question 3 and 4. We did question 1 and 2 already on Tuesday. So let's see what are your answers. So make sure once you answer it, please mention the number along with it. Karan had a question in the last one, how 15.5? Children, 1 into 1 point. I hope you did that, right? In the last question, I hope you had did calculate 5 plus 5%. So your D1 would have been 5.25. Yeah, it had to be a 15.5. Make sure that you had selected a D1 correctly. Okay. For the MCQs, I'm getting unanimous response. For question number 3, there is a little bit of a split, but majority is giving me option number D. Some people are telling me A. Guys, I hope the call of the question was clear. Which of the following statements are false? So there could be multiple answers, and if at all, it could be D, right? So retained earnings do not involve any cost. They involve the cost. So this is not correct. Implicit cost is this. Weighted average is the sum total of cost of capital. No, it has to be a weighted average applied. Tax shield on preference dividends reduces the cost of capital. Trust me, there is no tax shield on preference dividends. They're not taxable. So hence the correct answer had to be D, all of the above. So all the statements are false. Okay, what about question number 4? In question number 4, majority Janta is giving me answer as A, which looks to be good, because I told you government securities is more of a risk-free rate of return, guys. Wonderful. So I think question 4 is unanimously correct for everyone. And Sharon, you wanted to see that calculation again. You can do that, please. Sharon wanted to see the calculation of the last question again. Sharon, D1 calculation, please check that again, right? 5 into 1.05 upon 50 plus 0.05. You'll be getting roughly, I guess, 0.155 if I'm not wrong. Yeah, that's what you will be getting. So 0.15 is 155 is 15.5. Okay, guys, moving on. Now then, we are ready for the grand finale. Am I correct? We are done with individual cost of the capital in terms of cost of debt. That's what we did on Tuesday. Cost of preference shares, cost of equity, including the cost of retained earnings. Now, what we need to calculate is weighted average cost of capital. That's what we are here used or utilized in our further sessions of capital budgeting and working capital. So the overall cost of capital, because the companies are depending on different sources of capital, weights are applied to proportional to the total capital. So let's say we are talking about 2 upon, or rather 2:3:4, probably in terms of our investment in, let's say, debt, preference shares, equity. So we will have these weights in terms of, for the cost of debt, we'll be multiplying that by 2/9. For the preference, we are multiplying that by 3/9, and so on, depending on which component is there and what are the weights. So the formula is straightforward. Whatever the weights are, you multiply to the respective components and add them up. Right? Now, the very interesting point, what can be the weights? What can be the weights? Okay, there is a couple of students who are talking about the voice clarity. I hope this is absolutely clear to everyone, guys. I'm sure not everyone was talking about, so I'm assuming, guys, please check your connections also. Okay. So weights can be either the book value, or it can be the market value. Guys, please be with me. An important point here. If we are talking about book value, it's very easy peasy. We can just refer to the financials or the book value as per the balance sheet of the individual components. But when it comes to the market value, you need to tell me that if I'm telling you, hey, the market value of the equity share or the equity is so and so, does the market value represent separate values for the equity or retained earnings, or just one value? I need to get that answer from all of you. Do we get separate market values for the equity components, or we just get one market value? Sharon, we can, I think it's better you can check that later on. I think let's move ahead with that. Otherwise, you will miss this. Okay. So yeah. So guys, can anyone answer that? Market value is given just as a standard market value of equity, or is it an individual breakup? I think only one market value is given, right? And we have to take the weights. And let us assume that, let's assume hypothetically that cost of retained earnings and cost of equity is different. Then what do we do? So that is very important. If you are using market value as the weights, in the case of market value of the equity, you can proportionate that basis the book value of equity and retained earnings. Let me tell you an example here. Let's say there are in the balance sheet, or rather, let me use this. Let us understand this point. Let's say in a balance sheet, you're looking at 20,000 into 10. So you're looking at a 2 lakhs of equity share. And then we also have a retained earnings of 1 lakh. And let's say the market value of equity share is 24. So guys, what will be the total value of the equity as per the market? Some people said separate. No. Okay. We are not talking about face value, guys. We're talking about market value right now. Don't confuse. Okay. So guys, one or two students had some issues. So please check your connection as well, right? So 20,000 into, or rather 20,000 into 24 is 480 is the total market value. Now, if I had to see how much is equity and how much is retained earnings, my book values are 2 lakhs is to 1 lakh. Can we say 2 is to 1? That means 320 and 160, that would be my market value. Prachi, I'm just right now doing it. Prachi, I hope it is clear with the example. You said please re-explain this. What I was telling you, that market value of the equity share is given to you just one number. No one will give you that, okay, this is for your share capital, this is for your retained earning, right? But if we have different cost of capitals, different components, cost of debt, cost of preference shares, cost of equity, cost of retained earnings, you might need separate weights. So is it clear to everyone? Everyone with me on this? Can you please confirm, guys, that what are we looking at in this case? So basically, I'm trying to explain you this point, that where the market value is given and you have different components within equity, you can proportionate the total market value based on the book values. Right? Because of course there is no separate market for retained earnings, but yes, there could be different cost of capitals. Because we just studied that cost of capital for retained earnings and equity may not be the same ones. And hence we might need to split them up for getting the weights, right? So let's look at an illustration here. Cost of equity of a company is 10.41, but the cost of retained earnings is 10%. There are 50,000 equity shares of 10 rupees each and a retained earnings of 15 lakhs. Market price of equity share is given to you as 50. And we need to calculate a WACC using the market weights if there are no other sources of finance. What do you think, guys? What is happening here? Any thoughts? How do we go about this? In this case, we are looking at a total market value of 50 per share. That means 50,000 into 50 is 25 lakhs. From the book value perspective, we have equity 5 lakhs. We have retail earnings 15 lakhs. That means what is my ratio? 1:3. So market value can accordingly be split. Everyone with me on this? Let me just write it down here. So if my ratio is 1:3, my market value can be 1/4 into 25 lakhs, 625. And this will be 1875. Everyone with me on this? Okay, Prachi says did not understand the weighted average. Prachi, is it clear now? Basically, we are splitting up the market price based on the weights of the book value. Because in this case, we will be using the weights. We are using these weights for the respective cost of capital, guys. You can see that cost of equity is 10.41. That's multiplied by that weight. and the cost of retained earnings is also multiplied that way to get a WACC. We are multiplying the cost of capital with individual units here. Okay, couple of comments in the query box. 1/3 is okay, great. Sankaran understood, great. Manoj says if the retained earnings is negative, then how to, okay. So Manoj, what do you mean when we are talking about retained earnings is negative? We're talking about reduction of capital, losses. Will there be a actually cost of retained earnings in that case? My total equity will be anyways reduced, right? My total equity will anyways be reduced. Okay. Alok says we are taking weight as a proportion of equity share and retained earnings according to the ratio of market value. Alok, I just want to add one thing, that market value will be given you for the entire equity and we are splitting that based on the book value proportion. That's it. We're just talking about, we're just proportioning that based on book value. See, one can argue that the ratio will be anyways book value, right? Because even if I see the ratio of 625, 6,25,000 and 1,875, this will be anyways 1:3. It's just that because we are applying the market basis, because there could be other sources of finance like preference shares, debentures, then you need to have market values split up for all the sources of finance. Great. So I think having said that, let's target a very elaborative question, guys. I want everyone to be attentive right now. We're going to attempt a elaborative question here, which involves a calculation of WACC using the book value and market value as a weight. So let's talk about this illustration here. Dinesh says why 0.25? Dinesh, 1/4 is 0.25. When the ratio is 1:3, you will add them up, right? 1/4 and 3/4. Okay, so the capital structure of a company consists of 5 lakh debentures with market price of 105. Mind you, this will be important for us for the market value as a base or the weights, preference shares and equity shares. And they're giving you some additional information about these for debentures, for preference shares and for equity shares. Mind you, the next year expected dividend is ₹1. They're already giving you D1, I guess, with annual growth of 5%. Firm has a practice of paying all earnings in the form of dividend. That's interesting. Guys, what does this line indicate? Firm has practice of paying all the earnings in the form of dividend. I think we would like to all go for a investment in such company, right? I think that means there are no retained earnings. Prachi has a point. Book value as weights, market value. Okay. So Prachi will be again using the weights here in this question and the subsequent questions, so don't worry about it now. Okay, great. And Sharon, for you also, focus on this question, you will get more clarity. Now, they're specifically telling you in the question that please use YDM method to calculate cost of debentures and preference shares. Wow. That means we are calculating NPVs. We are talking about IRRs, kind of a recap of the last lecture as well. Okay, so let's try to do it together. We first focus on the cost of equity, guys. Now the cost of equity, my next year dividend is D1, right? So we talk about D1 upon P0 plus G. So D1 is 1. P0, it is given to us in terms of that the equity share has 4 flotation costs and the market price is 24. Hence 24 minus 4 is my denominator and the growth rate is 0.05. So K is 10%, guys. K is 10%. That's the easiest part of all. Abdul, it is more of a yield to maturity. Yield to maturity, YTM. Okay. Now we calculate cost of debt, guys. Now cost of debt, they're given some information here. 100 per debenture, redeemable at par, 10% coupon rate, 4% flotation cost and 10-year maturity, but we have to calculate YTM. So that means what will be our initial cash flow, guys? Initial cash flows. We're talking about 100 per debenture. Market price is 105. Can anyone tell me what would be my initial cash flows? Can we say because there is 4% flotation cost, it will be 105 minus 4% because 105 is the market price? Or do we need to do something else? Does it make sense? So if you look at 105 minus 4%, it looks to be a 100.8 is my initial cash flow, 100.8. Whereas the future redemption value will be 100. That's the face value you have to pay. Guys, everyone with me on this? Everyone got it that how did we get this 100.8, please? 100.8. And then we are talking about a 10% coupon rate, but there is a tax rate also 30%. So I into 1 minus T, 10% net of tax will give you a cash flow of 7, guys. 7 is the interest. Mind you, the rates, the signs are swapped, as I already explained. And the end of the majority or the maturity of the debentures, your cash flow is minus 100. So we are discounting them first at the 5%, which will give us a present value of 14.64. And because this is happening, anyone wants to look at probably how and why we are doing this? We discussed this in the last class also. I hope you remember that we are using a present value annuity factor because interest remains same every year. We are adding up the discounting factors of 1 upon 1.05, 1 upon 1.05 square, 1 upon 1.05 cube, and so on. We are adding up all the present value factors. We should be getting 7.7217. And hence, since we are getting a positive NPV, for the negative NPV, we will take a higher rate. We take a higher rate. We again discount these cash flows. Now, this time we decided to discount these cash flows by 7%. Second rate has to be a higher rate, guys. And look at that. What do we get? A discounted amount of minus 0.8. We get a minus 0.8, guys. I want everyone to be comfortable here. We are talking about these factors, discounting factors, based on the present value annuity, like I explained you in the last session, guys. But in this case, it is till 10th year. So this is probably the addition of 10 years factors. Honey says net proceeds. So we reduce the flotation cost from net proceeds. Honey, the net proceeds is the issue price minus flotation cost. Issue price will be the market price, right? 105. Dinesh says how to calculate discounting factor. Dinesh, I am just explaining you right now that, right? 1 upon 1.05, 1 upon 1.05 square, 1 upon 1.105 cube, and so on. We just discount each subsequent factor and we get it. Let me show you again. So let's say we are looking at a 5% here. We are looking at a 5%. So we're looking at 1 upon 1.05. We are again dividing it by 0.5. And we probably do it 10 times. when we add these, give me a second. When we add all these discounting factors, we would be getting a total present value of annuity factors, 7.7217. We're just doing a simple division by 1 upon 1 plus R. Okay, the question from Sufal is 5 and 7 are random rates. Okay, Sufal, you can take any first random rate. I explained this point on Tuesday also. You can take first rate as a random rate. Depending on if your NPV is a positive in the first rate, then the second rate should be higher, because you need one positive NPV and one negative NPV. But if using the first rate, the NPV is a negative, then use the second rate as a lower rate. Sharon, I hope this is clear now. Manoj, I leave it up to you, whatever makes you comfortable, right? So guys, once you have these two NPVs, you have to just simply apply our NPV or the IRR formula, right? That is lower rate plus NPV at the lower rate is 14.64 divided by 14.64 minus in brackets minus 0.8, that would be a plus now, and multiplied by higher rate minus lower rate, which is 7 minus 5, it is 0.02, and most probably you will get a 6.9 approximately. Absolutely perfect, Alok. Alok says we have to assume the second rate according to the result of the first discounting rate assumption. Dinesh, because in the first year, there is no discounting rate. That's the today's value, now's value. That is 1 upon 1. There is no discounting required for time 0. 0.614 is the discounting factor for the 10th year, na? Like we calculated here. 614. Dinesh, I hope this is clear now. This is 0.614, as I showed that, okay, that's the 10th year single annuity factor. So guys, I request everyone probably, do need to practice some concepts. What is present value annuity factor? What is present value factor? Guys, present value factor is just one discounting factor for one period. But whereas present value annuity factor is a total of the present value factors where annuity is involved. Annuity is the same amount every period. Prem Kumar says, how much maximum interval? Prem Kumar, it depends on, let's say if this positive value was, let's say 5,000. The next rate I would have taken 10%. But if it is negligibly positive, you can accordingly decide, right? But I told you that, lesser the interval, more accurate the results could be. Yeah. Okay. Let's talk about another one, cost of preference shares. Now, in the preference shares, what was given to us? What is market price of the preference shares case? 110. Please make sure everyone is with me now. 110 is the market price. And are there any flotation cost? 2% flotation cost, right? So 110 minus 2%. Abdul had where 7 came in the cash flow column. Alok, not here, please. I requested that in case you have anything with respect to the past year papers, I request everyone to please put it in the email to fm/inter@ici.in. Okay, so Abdul, 7 was a net of tax. You had a 10%, 10% into 1 minus tax. Now, in the case of preference dividend, 110 minus 2%. 110 is a market price minus 2% flotation cost. You have 107.8. It was a 5% coupon rate here. So preference dividend is a 5. There is no tax benefit, please. No tax benefit for preference dividend, minus 5. And then the redemption value. So we again use 5%. Guys, I want everyone to be attentive here. Using 5%, we are getting a minus 7.8. So all the questions coming in from different students, which were talking about how the two rates were taken from Sufal, from Dinesh or Prem Kumar. I think this is something you guys can easily rely on. That okay, since my first rate is a negative, second rate has to be a lower rate, and that's why I used a second rate as 3%, and so that my NPV is a positive number. Prachi, coupon rate refers to interest rate. Coupon rate is nothing but interest rate that will be paid out. Remember, we discussed on Tuesday some terms, right? There I told you interest rate or coupon rate, which will be paid. Okay. So using the same formula of YTN, the cost of preference share becomes a 4.09. So what do we have? We have cost of equity as 10%. We have cost of debt as 6.9. We have cost of preference shares as 4.09. And let's say now we need to calculate my book values and market values. What is my book values, guys? Given to us 5 lakhs, 5 lakhs, and 10 lakhs. So let's say this is my debentures. Then we have a preference shares and equity. 5 lakhs, 5 lakhs, and 10 lakhs. This is my book value, guys. So those of you who are not sure about what is weights, so we can add the total book value, and hence my weight will be 5 upon 20, 5 upon 20, and 10 upon 20. That's what we have done here. Book value weights. We have multiplied these weights with respective components of cost of capital to calculate my WACC, which is 7.75. Prachi says we can take any rate for finding. What do you mean by finding net proceeds? Prachi, net proceeds is basically the issue price, which is market price less flotation cost. Why would you like to use any rate? They will be giving it to you. Okay, Abhishek, then unfortunately you have to take the third rate. If you are again getting a positive NPV, you probably had to take a more interval. No other choice. We need two NPVs, positive and negative. Okay, what is market value, guys? So market value given is 105. So 5,25,000 of debentures. Preference share seems to be 550, and 24 lakhs seems to be equity here. Interesting. So we are talking about 525. So let me rewrite that again. So we're looking at a 5,25,000, 5,50,000, and 24 lakhs. So this is all given to us. So let's add them up. So it seems to be a 34,75,000. That means my weights will be 5.25 upon 34.75, 5.5 upon 34.75, and 24 upon 34.75. And we multiply all these weights by respective cost components, and to get a WACC of 8.57%, guys. So guys, I hope the values are okay here. The book value, market value, everyone is doing good. Sharon, if you're talking about the present value table, I recommend you to, probably look at any annuity table later on and use the calculator to cross-check your values. And the book values for this question, if you're asking the book values, Book values are given in the question. Market values are also given in brackets. The ventures 105, preference shares 110, and the equity shares 24. So guys, I hope this one is clear to all of you. Yes. So Prachi says, so Prachi, more or less you will be getting the discounting days just in case you do not have. So that is why I've explained you guys. Okay, great. So guys, one more concept, small concept we need to understand is something called marginal cost of capital here. What is marginal cost of capital? Now, again, marginal cost of capital as the term indicates, Dinesh says, what is purpose of calculating WACC? Okay, Dinesh, we will be seeing why WCC is important. You will be using this in the ratios, you'll be using his investment decisions, you'll be using it working capital management. As a finance manager, you need to do the wealth maximization, right? Wealth maximization is like what? Expand the difference between the returns and the cost. You know, you need to maximize the benefits and you need to minimize the cost. That's why the WACC is important. Abhishek, depends on the question. Abhishek is asking me whether we need to give both the answers, book value and the market value. In that question, it was given to us. You know, we had to calculate. Look at the top line, calculate WACC using book value and market value. If they're asking you only market value, you can give only one. Okay, great. So guys, marginal cost of capital is cost of raising an additional rupee of capital. And you know that marginal cost of capital, it's when it comes to the new equity, then marginal cost of capital can be slightly higher due to the flotation cost. We understand this, right? So it's very, very important that we are looking at. Vinay, just give me a second. I've just seen your query, but just give me a second. So for calculating the marginal cost of capital, the intended financing proportion needs to be known. Reason is, we know that, okay, the company may be financing its business, let's say using debentures, you know, let's say preference shares, equity. Now, within equity, there could be normal equity shares and retained earnings. And if the business has to expand and the company plans to use the same proportion, same ratio in which it is currently holding the capital, you may have to calculate that, hey, okay, let's take an example here for this one. Let's say my existing ratio is like this. We have a debentures of, let's say, 5 lakhs, preference shares of 5 lakhs, and equity of 10 lakhs. So my proportion becomes 1:1:2. And let's say the company wants to have a new project in which the company wants to invest, let's say, 5 lakhs rupees. Now we know if the same proportion needs to be maintained, they might go for a debt of 125, preference of 125, and equity of 250, guys. Everyone with me on this? And if I tell you that, okay, there is already a retained earnings of 1,50,000 and company wants to bring in a new project where 2,50,000 equity is required. Hence, the new equity to be raised is 2,50,000 minus 1,50,000 you already have is only 1 lakh. So the new project needs the same proportion of debt, preferences, and equity. And if you already have a retained earnings, your new equity will be only 1 lakh, not entire 2,50,000. Okay, Sharon says, please explain the weights and after tax. Sharon, we have a lot of questions to practice. We will be touching the weights again and again. Don't worry. Right now, I'm using the weights again, right? I hope you are concentrating. We are discussing the weights only here. 5 lakhs, 5 lakhs, 10 lakhs. These are my weights. So my ratio is 1:1:2. Right? So if we are using the same proportion, we are using the new equity here. And that's what I'm trying to explain in this one. When a firm raises the funds, look at this, in proportional manner and the components cost remains unchanged, there will be no difference between average cost of capital and marginal cost of capital. Reason is, what we are saying is, if you're not issuing new equity, because generally in the new equity, you will have the flotation cost. If you're using or raising the funds in a proportional manner, and your cost remains unchanged, there is no change in marginal cost. Whatever is your WACC is your marginal cost, guys. But the only problem is that will be true only till particular level. Like in the example I told you, 1,50,000 retained earnings was there in the business. Till that point, cost of retained earnings is equal to cost of equity. But if we need more than that, because we needed 2,50,000, that means my cost of equity will be slightly higher due to the flotation cost. I can other way around tell you that, hey, I have 1,50,000. If I divide this by 50%, okay, equity is 50%, right? Equity is 50%, everyone get it, 2/4. That means if the new project is only 3 lakh rupees, then there is no need of new equity. No need of new issue. But in this case, the new project was 5 lakhs and hence we needed to raise new equity. Guys, everyone with me? Retained earnings is already there of 1,50,000. We are calculating till what amount? We do not need a new equity. That's 3 lakh. Absolutely perfect, Abdul. Abdul already calculated that it's 3 lakhs. So till 3 lakhs of a project, you don't need new equity. Till 3 lakhs, my marginal cost of capital will be not a different one. It will be same as the WACC. But beyond 3 lakhs, my marginal cost of capital will slightly increase, guys. And that is this point. This is the point where my WACC gets a marginal bump. The cost will be same only to a point, till the point we are not raising the fresh capital, guys. This is a very, very interesting and important point. And I'm sure looking at the reactions, most of you got the concept pretty clear here. Anything, anyone want to ask anything, let me know. I hope this is pretty crystal clear, and maybe what we can do is we can look at a comprehensive question to kind of go around this concept once more. So let's look at a comprehensive question now. Give me a second. So guys, I hope everyone can see working here, but I'm just trying to change the link here in terms of so that everyone can see the question as well. Let me know once you guys can see this. Okay. Any questions so far, guys? Everyone wants to ask anything till this point before we go for the comprehensive question? Anything you want to ask me on this? Okay, let me just quickly see. Great. Okay. In the meantime, let's do one thing. I will come back to this, the comprehensive question in a while. Let's quickly do a different question, which will kind of explain this concept to you guys of marginal cost of capital, guys. So let's see this. I hope now you can see the question here. A company wants to raise the additional finance of rupees 5 crores in the next year. The company expects to retain 1 crore earning next year. Further details are given to us. Yes, Sofal, absolutely correct. Yeah. So the amount will be raised by equity and debt in the ratio of 3:1. Additional issue of equity shares will result in the price per share being fixed at 25. The debt capital raised by the term loan will cost 10% for first 75 lakhs and 12% for the next 50 lakhs. Net expected dividend on equity shares is 2. And the dividend is expected to grow at 5%. What we need to calculate here is the amount of equity and debt for raising the additional finance, post-tax average cost of additional debt. Mind you, the word is additional here. Additional finance, additional debt. To determine the cost of retained earnings and cost of equity, and of course, the overall weighted average cost as well. So very, very interesting question here. Now, let's start calculating what exactly do we need in this case. We are talking about an additional finance of 5 crores. 5 crores. And the company is expecting to retain 1 crore. Now that means if we are talking about the ratio, can you tell me, guys, how much is the debt and how much is the equity do we need? Let's start by understanding this, because we just studied marginal cost of capital and we all know that, okay, hey, beyond a point, the cost may change. How much of the debt we need and how much of the equity will be needed? Honey, we are just right now doing that. So I'm just waiting for the answers from all of you. Okay. Jay Kumar says 3 crore equity, 1 crore debt. Piyush says 3.75, 1.25. So some people are saying 3 and 1, and some people are saying 3.75 and 1.25. Amazing. Okay, guys, let us cut this short. We know that the ratio is 3:1, and we need 5 crores. So if we say 3:1, 3 by 4 into 5, we get 3.75. We debt gives 1.25, but we already will have a retained earnings of 1. That means new equity will be 2.75, guys. Can we say that? Can we say that new equity will be 2.75? 2.75 new equity and debt of 1.25? Everyone okay with that? Okay. Now, having said that, what will be the so amount is clear. So point number A is clear, right? So amount of equity will be needed 2.75 and debt will be needed as 1.25. So point number A is clear to all of you. Then we are looking at point number B. post-tax average cost, guys. Look at the word average cost of additional debt. And we are talking about 1.25, mind you. 10% for the first 75 lakhs is given to us. And as we need more and more debt, the debt is becoming expensive, 12%. And we are looking at cost of debt, which is generally 1I into 1 minus T. That means for the first 75 lakhs, it will be 7.5%. And the next 50 lakhs, it will be 12% into 75%, guys. That is 9% if I'm not wrong. So what will be my weightage here? 3 by 5 into 7.5 plus 2 by 5 into 9. How much is you're getting, guys? Can anyone do this quick calculation for us? Are we getting 8.1 here or something else? So the answer to point number B is 8.1. Someone is asking me how we get 3 by 5 or 2 by 5, guys, because what I did was I just used this proportion, right? 75 is to 50, 3 is to 2. 3 is to 2 is the proportion here. Jyoti, I just answered that, right? 75 and 50 lakhs. That's because we are talking about average cost of debt. So Jyoti is like, we anyways do the weights. Now it's weights inside the weights, right? Because before we even go to the weighted average cost, even the debt involves two components, Jyoti. That's why. Okay. What is the cost of retained earnings and cost of equity, guys? Let's calculate that also. The cost of equity in this case looks to be D1 upon P0 plus D. And that anyways is given to us. So what is given to us, guys? D1. Sharon says 50 lakhs, it's 6%. How 6%? Tax is 12, tax is given to us 25%, right? So 12 into 1 minus 0.25, it should be 9. Sharon, you can check your calculation again. So what is the cost of equity here, guys? Next, the net expected dividend, I believe that is what they're trying to say is next expected dividend is 2. And the only point is, are we looking at a net or a next? Right? If it is net expected dividend is 2 per share and we're looking at a D1. So what will be D1 in that case? D1 will be 2 plus 5%, guys. So my cost of equity will be 2 into 1.05. What is P0 for us? 25. Can anyone do that mathematics? What is cost of equity here? Someone said 13%, someone said 13.4. Okay, so majority of you are telling me 13.4%, I guess. Great. So guys, now we are getting 8.10% as a cost of debt, and cost of equity is a 13.4%. The last step is to compute the overall weighted average cost of additional finance. We know that how to do that, right? We know our weights 3 by 4, 1 by 4, 3:1 was given to us. We just have to multiply this so that we get the weighted cost for each component and we just add it up to get 12.075. Okay, Prachi, if they're giving you the next year's dividend, that's D1. In that case, it was net dividend, net expected dividend. So we are talking about the current year. So that's why we are doing the next year into 1 plus D. Everyone with me on this? Everyone okay, guys? Got the cost of weighted average cost of capital 12.075. Okay, so guys, I think what we can do is now probably we can. It's almost 7:15. We can take a quick 10 minutes break here, and once we come back, we will have a lot of practice on the other side, and then we will also do some MCQs. So let's have a quick 10 minutes break. Great. Okay, guys. So, welcome back. I hope it was a much awaited and deserving break for everyone, and I'm sure everyone is refreshed. Before we move ahead, I'm looking at my query panel, and I have a couple of questions. So, majorly one coming from Vinay and one coming from Abhishek. So Vinay says, in this sum, the marginal cost of capital ends with finding the proportion of equity and debt. See, again, Vinay, the concept of marginal cost of capital applies when we are talking about two things, right? Either additional equity is not required, then there is no marginal cost of capital. It is same as the weighted average cost of capital. But when we are talking about new equity, then the cost of capital will change. I will talk about this in a comprehensive question in that as well. How the WACC will change at one point in time. We'll talk about that with that illustration right now. Okay, then we are talking about question from, okay, one more question was there from Vinay in terms of when we should go from with the cost divided by average investment formula. Okay, in this case, Vinay, it was a interesting question where there were two different cost of debts were involved, right? So there were two different cost of involved here. And in that case, what is happening is we need to get one cost of debt, right? There were two cost of debt were two types of debt were involved, and we have to calculate one cost of debt, and that is why we use that ratio or proportion, I would say. Make sense? When it comes to YTM, yield to maturity method, then they will be giving you in the question that, hey, you need to calculate the cost of debt using YTM. So don't worry about that. Abhishek talked about the dividend. We are talking about whether we need to calculate the growth with respect to D1. So Abhishek, when it is clearly mentioned that what is the next year's expected dividend, then we are using one, we are not using 1 plus D, we are just treating that as D1. But in that question, it was majorly a net expected dividend. That's why we calculate the next year's dividend, right? Okay, so let's do one thing. Let's do a very, very interesting question. Let me know if you can see this now on my screen. This is the question I was talking about. So Dhamaka Limited, the question starting with Dhamaka Limited, right? We have a following capital structure, which is considered to be optimum as on 31st March 2019. So 14% debentures, 11% preference shares, equity shares 1,60,000, that is total 2 lakhs. Company share has a market price of 23.6. Next year dividend per share is 50% of 2019 EPS, and they've given you some table for trend of EPS for the last 10 years. Now, they're also telling you that the company issued new debentures carrying 16% rate of interest, where the market price is 96. Preference dividend is given to you, and they're giving you a lot of things to be calculated. Question A, B, C, D. Specifically with respect to the question which was asked by Vinay, the marginal cost of capital will be very much evident when we will be looking at questions B, C, D here. Are you getting me? So let's start solving it one by one. My first question here is, what is the cost of new debt? What is the cost of new debt? They've given you information, issued new debentures carrying 16% rate of interest, and probably I can give you 1 minute to give me the answer. Cost of new debt. Mind you, we are not even talking about with respect to of a YTM here, right? So give me the cost of debt. 1 minute for everyone. Okay, let me see what are the responses. People are giving me 8.33 or 16% as well. Okay, guys, those of you are telling me 16%. I hope you guys are taking care of the tax part, I guess. There is a tax element also. 50% tax bracket. So 16 into 1 minus t divided by 96. I think it should be 8.33%, right? Cost of new rate. Okay, that's what the majority of the answers are. Great. Abhishek, 8.33, something you need to check. Okay, can anyone also give me the cost of new preference shares? So what do we have for preference shares, guys? 9.2, annual dividend is 1.1. I'm not sure whether we need to give a tax benefit on the dividend, right? It should be very straightforward. Cost of preference share is 1.1 upon 9.2. I think 11.96, probably 12% or whatever, right? Okay, I think the most interesting part in this question would be what? What would be the most interesting question here is probably to calculate a cost of equity, guys. To calculate the cost of equity. Okay, so let us do that as well. Okay, in this one, what exactly is being given to us for calculating the cost of equity? Yeah, 11.96, 12, that's fine. I think we can always follow the rounding off instructions, but 11.96 is the accurate one. And 12% is rounding off for the cost of debt. So I think 8.33 is what you guys told me here. This is 11.96 or 12, that's okay. New equity share, assuming new equity from retained earnings. Wow. So how do we calculate, guys? They're giving you the market price of 23.6. Next year dividend per share is 50% of 2019 EPS. So 2019 EPS is 2.36. 50% is 1.18, if I'm not wrong. The only point I need to check with you guys is what is the growth rate? Have they given us a growth rate? If I have to calculate KA is equal to D1 upon P0 plus G. That means what we are looking at here is okay. Vinay, if you don't mind, can I look at that query in a moment once we discuss this cost of equity? Let me just solve this for everyone. Then I will relook at that query in case I was not able to answer earlier. Okay, so D1 is 1.18. Where they're saying next year dividend, mind you. What is P0? 23.6. But what is the growth rate here? If you look at all these EPS, do you see a trend, guys? I can see all the years the EPS is rising by, I think 10% if I'm not wrong. So can we say it's 0.10? I think some of you are talking about the module question, guys. You can right now focus on what I'm sharing on my screen. I think probably there could be illustration numbers could be changed. So don't worry about that, please, for the time being. Don't even worry about that. Okay. So that means we are looking at a 15%, right? Now, okay. So let me just quickly go back. When I was asking me something, Okay. Vinay, I believe in that question, we were specifically told to follow YTM method. Okay. So don't worry about that. Just follow the question's instructions. If the question is silent, I would recommend YTM because it will give you a little bit more of a accurate information, close to approximation. Okay. So guys, what is question number B now? Question number B is calculating the marginal cost of capital when no new shares are issued. Guys, what did I tell you? When no new shares are issued, what exactly we are doing? When no new shares are issued, I told you WACC is equal to your marginal cost of capital, guys, because there is no flotation cost. Jyoti says why 1.18 is taken, because Jyoti, the question tells us that the next year dividend is 50% of 2019 EPS, and on the screen the 2019 EPS is 2.36. That is why we are doing it. 2.36 into 50%. Now, if you have to just calculate the WACC here, marginal cost of capital is same as the one. So basically, we need to just know the weights, right? So what is the capital structure? If we have to calculate, what is the capital structure? We have 3:1:16. So what will be my WACC? You have a 8.33. That will be a 3/20. You have a 12 into 1/20, and you have a 15 into 16/20. That will be my cost of capital, if I'm not wrong. Weighted average cost of capital, which will be same as marginal cost of capital, because there is no new equity. Guys, can anyone tell me the answer here? Okay, someone says it's 13.85. So we're done with question number B also. So let me see if everyone is on the same page. Anything unresolved on the query panel right now? Okay, great. So moving on to question number C, guys. Very, very careful, guys, when you are looking at question number C in this case. Determine the amount that can be spent for capital investment before new ordinary shares must be sold, assuming that retained earnings for next year's investment are 50% of 2019. So what is the retained earning for 2019? Retained earnings for 2019 is 50% of 2019, right? So what we are looking at? Anyone? I think 2.36. Guys, 50% is what we are paying as a dividend. So 2.36 into 10,000, or what? How much is your number of shares? So can we say this is 11,800? Sharon, we are looking at the question on the screen. So guys, can now you tell me how much amount that can be spent for capital investment before new ordinary shares must be sold? Mind you, for answering this, you can actually use the concept I explained you before the break. The concept which is on this slide. Remember, I told you in this example that till 3 lakhs of investment, no need of new issue. So what they're asking you here is, what is the maximum amount of investment where no equity share is required? Mind you, 11,800 is my retained earnings. And I think my ratio is 3:1:16. Can anyone tell me how much is my percentage for equity here? I think percentage of equity is 80% clearly. 16/20 is 80%. Hence, maximum investment for any capital project which you may start without using fresh equities, 11,800 divided by 80%, which is coming out to 14,750, which also means out of 14,750, equity is financed by retained earnings, and balance of 2,950 can be financed by additional debt or preference shares. Everyone okay, guys? Point C is clear. I think probably a couple of you were asking me about the concept of marginal cost of capital is now getting much clearer with this comprehensive illustration. Till 14,750, no new equity is required. Guys, if it is clear to everyone, we can move to the last leg of the question, part number D. Question number D here. Great. Very good. Now, that means, now, if we look at the call of the question in point number D, we're looking at compute the marginal cost of capital when the fund exceeds the amount calculated in the point number C. That means now we have to invest more than 14,750. It could be 15,000, it could be 20,000, it could be 1 lakh, anything. Now the marginal cost of capital beyond 14,750, marginal cost of capital beyond 14,750 will not be equal to the current WACC. Prachi says, how 11,800? Please explain. Prachi, they were talking about the retained earnings for the next year's investment are 50% of 2019, right? And they've given you earning per share. So total earnings was 2.36 into 10,000. Prachi, 10,000 shares we have. 10,000 and earning per share is given as 2.36. So total retained earnings or total earnings is 23,600, and we are planning to retain 50% of this. That is given to us in the question itself. So 50% of 23,600 is 11,800. And if that has to be equity contribution, which is 80%, so 100% capital investment will be 11,800 divided by 80%. 14,750. I hope it is clear now. Honey, Prachi, Vinay was already pretty much on the track. And so was Dinesh Abhishek, Ankit, great. Thanks for the confirmation, guys. Okay, so guys, now we need to calculate the marginal cost when the funds exceed the amount calculated in C. So what will change? Will cost of debt change? Will cost of preference shares change? No, they are anyways the cost of new debt and cost of new preference shares. What we need to calculate is that if the new equity is issued at 20 per share, what is the new cost of equity, guys? Sufal, absolutely wonderful. Sufal said balance 2950 will be between debt and preference shares. Sufal, that's absolutely correct. But we don't need to worry about that. Just for explanation, just for understanding, I told you this fact. Amazing, guys. So can anyone tell me the new cost of equity here? I think not much will change. Probably we have a 1.18 D1 upon P0 plus G. So 1.18 doesn't change. 20 will be a change here. And plus what we have, a growth rate is your 10%, right? If I'm not wrong. It seems to be a 15.90. And hence, my marginal cost of capital will now be you guys can calculate the same now. Whatever it comes. Okay, so new cost of equity is 15.9 and accordingly your WACC will change. That will be your marginal cost of equity. All okay, guys? Absolutely, Alok. So I think some of you are giving me 14.57. Amazing, guys. Wonderful. I think probably after doing this comprehensive illustration and the illustration we did before the break, I'm sure you guys, most of you would be feeling confident about cost of capital topic already. And for your later reference, that presentation already has the solution what we just worked out together. You guys can refer to this later on again. This is anyways there for your reference, guys. With that thought process, I think I will be more interested in checking a couple of MCQs with you guys. So why don't we do one thing? Let's attack these couple of MCQs quickly. I'm giving you 2 minutes, everyone to respond, guys. These two questions, I want answers from you. In fact, the first one is an MCQ. Second one is more of a objective question, which I suppose you can answer quickly. Guys, again, if you have any questions in the related to the past year questions or any other study material query, I request you guys please post that query. I think some of you were repeatedly asking me about illustration 4, I guess. Give me a quick second. Is this the question you guys are talking about? I think some of you were asking me this question, illustration 4 earlier, which were talking about the deep discount bond where where we're talking about more of a 0% rate, but there is an implied interest. Like, what is the rate we are talking about? So I think the same logic is being used over there, right? See, again, the logic in this one was majorly that the deep discount, which was more of a calculated with respect to the annuity, that your net proceeds is 2,500, redemption value is like 1 lakh. So basically that what we're looking at is the 1 lakh is more with respect to the future value, and we need to calculate that rate. I think some of you were asking me about this question, so just think it from that perspective, guys. In case you still have any question, please reach out to us on the email ID given to you. I think the logic is the same, which I explained you guys. The only thing is we are just using that as a difference with respect to the number we need to arrive at as a geometric progression of 40. Either way around, we will get a positive and a negative number. Okay, so make sure that you guys can relook at that later on. And if you guys are still not clear, please email us your query. Okay, so majority of you are giving me the answer for question number 1 as point number C, which looks to be good. Which of the following cost of capital required to adjust tax? Of course, cost of debentures, equity preference, retained earnings. There is no tax benefit. Okay. What about question number 2, guys? Did anyone calculate question number 2? Anyone calculate question number 2? I think someone said 15.05%. Okay, so I think the only thing we need to do is see, the cost of equity is given to you 16%. Income tax rate is given 30%. That will change this cost of debt, right? So cost of debt will be 15 into 1 minus 0.3. So probably 10.5%. And then you have to just apply the weights. You just apply the weights, right? So weights are 50, 35, and 15, 15, and 35. And we just need to multiply and come out to 13.48%. Everyone okay now? I think, yeah, some of you already answered 13.48. So good job. So Jay Kumar says 13.48. Others, few other answers are also coming to be 13.48. Piyush and everyone else. Great. Okay, let's quickly look at a couple of more MCQs here. Question 3 and 4 now. Okay, so what are the answers here? Okay. Question number 3. I think majority of you are, in fact, right now I can see a little mixed responses. Which of the following is an implicit cost of increasing the proportion of debt of the company, guys? I think it's a very, very good question, trust me. Majority Janta says C, and you will be glad to know that yes, C is the correct answer, but let me talk about this for a moment. Now, implicit cost of increasing proportion of debt. Guys, if we keep on increasing the debt, it will be a little bit more risky to the organization. So investors, owners might feel insecure. So when we say PE ratio of the company would increase, first of all, it is not an implicit answer, right? We're talking about implicit. The word is implicit. If we have to calculate some numbers, it would be more of an explicit domain, right? Anyways, the PE is, market price upon earning. And trust me, if we are talking about earning per share, it would increase if the financial leverage is taken care of, and it might actually, probably the ratio might decrease. But anyways, we are not even talking about explicit numbers. We are talking about implicit cost. Tax shield in interest would be less. That's absolutely irrelevant because that entirely depends on the tax laws. And again, it's not an implicit. Return on assets may decrease for the same reason, but equity shareholders would feel more insecure. It will increase their expectations because their capital is not so secure now because they are more into debt. So C is the correct answer, guys. So those who got C, it's perfect. Okay, for fourth, majority are easily telling me it's B. I think that was a very, very easy one. When we are looking at preference dividend is 18, and we are looking at a 122 minus 4, probably 118. I think that's what everyone did. So 18 divided by 118 into 100, giving you a 15.25%. Great, amazing. So okay, let's now also attack on let me see which question would be a good one for you guys. Yeah, so I think we can actually do the question on the screen right now. Everyone can see the screen, guys. ABC Limited has the following book value capital structure. They're giving you equity, share capital, reserves and surplus, 9% preference share capital, 5 lakh shares of 100 each. So make sure we understand that, okay, all these numbers are in lakhs. 8.5% debentures. So we have 1.5 lakh debentures of 1,000 each, or 12% term loans from financial institutions. Now, debentures of ABC Limited are redeemable at par after 5 years and are quoting at 985, guys. Okay. The current market price per equity share is 60. Prevailing default risk-free rate on the 10-year Government of India Treasury bonds, that is 5.5. Risk premium is given and beta is given. So guys, I hope everyone is clear that we are looking at a capital asset pricing model here. Not only that, we are also saying that, okay, preference shares are also redeemable after 5 years. Now we need to calculate the weighted average cost of capital using the market value as a weight. Someone was asking earlier, how do we know whether we need to use a book value or market value? In this case, it is specifically asked market value weights, guys. Specifically, we are being asked here. Okay, so let's try to calculate the cost of debt using our usual formula, not YTM. So cost of debt using the usual formula, guys. So if they tell you YTM, please use YTM specifically. So can anyone tell me what would be the cost of debt? Sharon says, please explain the NPV table. Guys, NPV table, I have been telling you since we started that it's majorly 2 types of factors you will always have over there. One would be a present value factor. One would be your present value of annuity. So in case you guys want to look at this one, the table on my screen right now, this is the compound interest. Let us go to the present value. This is the present value factors. Everyone can see that, guys? So present value factors now on my screen. So these are the present value factors for individual periods. Let's say we talk about calculating. Everyone knows 1 upon 1.10 is 0.909. This is given 0.909. But we again do 1.1.0 square, we get 0.826. This is given 0.826. And what if we combine these two guys? 0.90, 0.826, we get a present value annuity factor for 2 years, 1.735. So Sharon, if you can go to the cumulative factors, you will find 1.735 or 1.736 here itself. So annuity factor is the addition of the individual present value factors when you have a uniform annual amounts. But if you have every year, you have different amounts, unique amounts, and you have to calculate the present value factors. You can't use annuity factors in that case. You will have to use the individual present value factors. Great. So I hope, Sharon, please try your own efforts now. Let's go back to our question and focus on the cost of debt, which is being given by many students as around 8 point something. Interesting. I think slightly varying. I think Vinay said 5.87. I hope you guys have given 8%. I have taken care of the tax rate. Tax rate is 35%. So debentures, we're looking at 8.5%. Will it be after tax, of course? So what is the formula you guys are using for this, guys? I think 8.5, 1 minus 0.35 plus, it's again existing debentures. 1000 minus 985, I guess, upon 5, and whole divided by the average. I think the Janta is telling me, majority of you are telling me that it probably should be 5.87, I guess. 8786, okay, that's okay. Yes, can you double check, please? I think majority are giving me 5.87. Is it clear to everyone? Great. Okay, so guys, there is one more debt I can see, right? Loans. 12% loans, right? So cost of debt in terms of loans would be 12% into 1 point minus 0.35. Is it 7.8, guys? There is one more debt we are looking at. Long-term loan, 7.8%. Apart from this, you also need to calculate cost of preference. Pretty similar. So we have 9 plus 100 and 2 minus 100. Or we do something else. I think redeemable is 10%. So it's 110 minus 102, right? Am I correct, guys? So the redemption is at 10% premium, which is given to us in this question. So probably it will be 110 minus 102 upon 5 and that is your average here. So what's the answer? Cost of preference shares. Everyone getting 10%, guys? So basically we're looking at 10.6 upon 106, all getting 10%. Great. Okay, so what is the last element we need to calculate, guys? I think cost of equity, the most important of all, and which is anyways being talked about in terms of the CAPM. Now, cost of equity, as per that, is Prachi, can you just double check? I think it seems to be 10% exact. So cost of equity is risk-free rate plus beta into RM minus RF. Now, I need to request you guys to be very, very careful here. They are giving you average market risk premium as 7%. So mind you, they're already giving you RM minus RF, please. 7 is already given to you, RM minus RF. Hence, it will be 5.5 plus 7 into 1.85. What are we getting at? 7 into 1.85 plus 5.5. I think we are getting the cost of equity using the CAPM as 18.45%. Honey, that will not impact, right? Even if it is 1000. That will not impact. I know what you're trying to say, that is probably we should write not 8.5, but rather we should write 85, right? That's fine. Good observation. Honey, I hope that's what you were trying to say. Because it's 8.5% of 1000 is 85. Taken your point, but I think we calculated correctly, if I'm not wrong. Prachi says, in cost of preferences, why we are taking 102 and not 100? Redemption value minus net proceeds. This is existing one, na? Existing preference share. So market price is 102, Prachi. 102 is the existing price. And redemption value is given to us 10% premium. So 110. So guys, once we are all done with all these cost of debts, both the types of cost of debt, cost of preference shares, cost of equity, last leg is just to calculate the WACC using the market weights. So we can apply the market weights here. You can see in terms of the market price for equity 60, 102 of preference. Mind you, we are using the numbers are in lakhs. Debenture 985. Term loans will be same. What is given to us? 500 lakhs. Right. So we had 1.5 lakh debentures, and that's why we multiplied by 985. And we calculate the weights, and we are applying them with the individual cost of capital, which what we just calculated, which gives us a 15.12. I'm giving you guys a couple of minutes to just double check if you guys are also on the same page. Once you confirm, probably we can just have a look at one more question for the day. I hope everyone is getting to the same numbers. Okay, Vinay says, why are we not calculating cost of retained earnings? Interesting. Why are we not calculating the cost of retained earnings? My question to you would be, Vinay, it's a very, very good question, by the way. Are we issuing new equity here? If answer is not, will the cost of retained earnings be equal to cost of equity? And hence, there is no need of bifurcating the market value of the equity into equity and reserves. Vinay asked a very, very good question, by the way. So Vinay, in that case, if it is same, even if you would have bifurcated between equity and retained earnings, the answer would have been same. You are just equating the same factor into two. Vinay, I hope it makes sense. But a very good question nevertheless. Okay, so moving ahead, guys, let's target one more practice questions for cost of capital, and I think that would be good enough for you guys. And the question which is on my screen, starting with Mogambo Limited, right? Don't worry about the other Mogambo. I'm sure when you guys probably practice, definitely Mogambo will khush hua, right? So let's see what is this question talking about. Mogambo Limited wishes to raise additional finance of 10 lakhs for meeting its investment plans. I'm very much excited when I look at this term, additional finance. It has rupees 2,10,000 in the form of retained earnings available for investment purposes. Further details are given to us. Debt equity mix 30/70. Cost of debt before tax up to 180 is 10. Mind you, it is before tax, so we might have to worry about that. If there is tax rate given to us 50%. So there is up to 180 is 10%, and beyond that it is 16%. So probably if it is before tax, we are worried about, or we are concerned about 5% here, and we are concerned about 8% here, because that's after tax numbers. EPS is given to us, dividend payout is given to us, expected growth rate is given, current market price is given. We need to calculate to determine the pattern for raising the additional finance here. Additional finance. Now, I think you guys have been superb till now, and I'm sure you guys will be continuing to be superb. Can you tell me how much share capital would be needed here? How much share capital would be needed? Abhishek has a very interesting answer already. So guys, my humble request is, I think earlier also many of you did that mistake. Do not reduce the investment. Do not reduce the investment by the retained earnings and then apply percentage. No. Apply the percentage first, because retained earnings is also equity. Apply the percentage of mix first, and then whatever the equity you get, then reduce the retained earnings from that. And that's what many of you are done. Dinesh, Vinay, Jaya, Piyush, Abdul, amazing guys. You guys are absolutely on the top of the game now. I think I'm sure when we started today's session, there was a little bit lack of confidence, and I'm sure now you guys are getting up to it. You're getting hold of it. So 10 lakhs, when we divide into 30s to 70, my equity is clearly 7 lakhs. But mind you, 2,10,000 is already there. So that means we need a additional 490 as the equity shares. 4,90,000. So that is the pattern we need to know. Point number A. But mind you, hold on. I think game is not yet over. Even the debt is of two types. If debt is also 3 lakhs, I think we are looking at 1,80,000 at the rate of 10% and 1,20,000 at the rate of 16%, if I'm not wrong. Yes, Manoj, absolutely correct. Bonds, debentures, same way of calculating, right? Okay, guys, everyone okay till this point? So I think point number A is clear to all of you, the pattern here. In fact, we can straight away understand from here itself. So that is what we just calculated. So we just concluded that yes, the share capital worth 4,90,000 is required, and debt comprises of two components: 10% of 180 and 16% debt of 120. Okay, now the next question is, we have to calculate post-tax average cost of additional debt. Then we have to calculate cost of retained earnings and equity as well. So in this case, as we said, 10% after tax is 5%, 16% after tax is 8%. And what's the ratio we are looking at? 18:12, which is nothing but 3:2. So 3/5 into 5 plus 2/5 into 8. That means 6.2% cost of debt. I think many of you already calculated 6.2. Great. Jay Kumar is ahead of the game. All okay, guys? Everyone doing good? Honey says, please explain again. Honey, which part? Honey, we are talking about two types of debt here. 10% debt and 8% debt, and we are looking at 1,80,000 10% and 1,20,000 with the the 16%. Now we need to just calculate the post-tax average cost of additional debt, and additional debt is total 3 lakhs. So we take the post-tax, 10% ka will take 5%, for 16% will take 8%, I into 1 minus t. I into 1 minus t. And that we just multiply by the weights within the variety of the debt. We are using the weight within the debt. So 6.2 clear to everyone, guys? I hope it is clear to everyone. Now, they have also given to us earning per share as 4 and dividend payout is 50%. That means D0 is 2 and growth rate is 10%. So that means D1 is 2 into 1.1. 2.2. Honey, point A is the same like what we did earlier, that since you need 10 lakhs of investment and your debt equity ratio is 3:7, you would be needing 3 lakhs of debt and 7 lakh of equity. And you have 2,10,000 of retained earnings already available. So 490 is what you will be using the share capital. So I'm just repeating it because Honey was asking about it. So great. So guys, that means if you look at the cost of equity, D1 upon P0 plus G, so 2.2 divided by 44 plus the growth rate. I think everyone okay with the cost of equity of 15%, guys? Cost of equity is 15%, guys? Okay. Finally, if the cost of equity is 15%, we know how to calculate the cost of debt or WACC now. Now we know the weights 70:30. We're just applying 70% and 30% on these respective rates, guys, to get our weighted average cost of capital as 12.36. 12.36. And I'm sure everyone understand that we are looking at a new equity here. And that's why we are just using entirely the equity portion with that cost. Because when we are looking at the new equity, then the cost of retained earnings is same as the cost of equity only when we are using the new equity cost. Otherwise, the retained earnings scale, you would be doing existing equity cost. In this case, it's already included. So that's why we're looking at like 6.2 into 30%. We're not even worried about other factors. Great, guys. Amazing. So, guys, once we are done with all the, okay, Pranav, I think it was just a coincidence when your query came in and I was just explaining. Pranav says, as new equity is issued, cost of equity and retained earnings should be different. That's exactly at the same point I said. And in this case, since in this case, they have not even given us anything with the new equity, they're talking about the current market price. So we don't have a kind of a flotation cost, and that's why it is safe to take a same. Pranav, very good question. And I think probably the same time I also was explaining the fact. I hope it is clear now. No flotation cost given, safe to use. If the flotation cost was there, yes, I agree to your point. Then, of course, there would have been other factors. There have been a cost of equity should have been a existing one for the retained earnings, and for the new equity would have been a different cost. Amazing. Great, guys. So let's do one thing. We talk about one question for everyone as a homework. And that is on your screen. That is a Navya Corporation. And don't worry, you guys have the solution also. But my request would be that please try to do this question on your own first. You know, it is a very, very good question. You are talking about a project which is, you know, having a project cost at different intervals. We are looking at up to 2 lakhs, 2 and 5 lakhs. And so on, and they're giving you the cost of debt and equity changing at every level, and they're asking you the cost of capital where the funding requirements are at different ranges. You can see that, you know, 6.5 lakhs for project X, project YK you have a 14 lakhs. So probably for every particular you know, project interval, what you need to do is you have to calculate cost of equity and cost of debt. So you will be having a WACC for each interval, guys. Each interval. And then project X will fall at third level, I believe, 6.5 we are talking about. So project X will fall here, and project Y will fall here at a fourth category level. So basically, this question may require you to calculate 4 different WACCs, and you need to just map it the best one, right? Which range you're talking about. So project X in the third range, project Y is in the fourth range. Now, I think this, I'm sure you guys can try this question as a homework, and I hope you guys are pretty much clear now in terms of the cost of capital concepts at large. Specifically, a very, very important topic what we discussed today was marginal cost of capital, and then how does the new projects entail the discussion of what needs to be brought in terms of additional finance. So guys, at the end, before we yes, Abdul, of course, lower the WACC. That's what would you want. Yeah. So guys, before we end the session, a humble request, make sure that we all understand always that there are no shortcuts to success. Of course, 3 things you need to do to succeed: practice, practice, and practice. No other shortcut. And trust me, if the kind of schedule I'm sure each and everyone is following, carrying on a lot of hard work and working with a lot of discipline, dedication as well, I'm sure you guys will definitely find the things pretty smooth. I think today's class is a perfect classic example where we started. We were all a little bit of a hazy. A lot of questions coming up. There was a little bit lack of clarity, but once we probably solved 4 or 5 questions, we are in much better shape now. And I think that momentum needs to be carried on. After the session, I request everyone to read the chapter again, do a lot of practice questions from the past year exams, and I'm sure you will be sailing good. And I'm sure I'm looking forward to meet all of you probably another 10 days or so. We will have our next session on investment decisions, capital budgeting. So we'll have a couple of sessions on that. And then towards the end of the month, we'll also work on working capital together, guys. So it was wonderful, guys, for being your chauffeur, serving you guys on some important concepts. And let's hope for the best that this momentum and this interaction continues. Thanks for a lot of two-way traffic coming in, a lot of questions being asked, a lot of discussions being there. So thanks everyone. Take care. Best of luck. See you later in upcoming sessions as well. Cheers, guys. Good night, all of you.